Very good evening, delegates. Welcome to Auditing Series CP program. Today is the 5th series of Auditing Standards. We have with us Subramania Sarma sir, who will take us through special aspects in reporting, SA 700, 701, 705, 706, and CARO compliance. I'm happy to introduce sir. CAG Subramania Sarma is a 63 years young fellow chartered accountant. He is a partner in a leading firm since 1992, in charge of Chennai and South. He has presented papers on simplification of company law provisions at the CASE conference held at Chennai. He has handled the sessions at the Tamil Nadu West Mambalam Study Circle on usage of Excel as an audit tool, accounting standards and auditing standards on different occasions. He has also led the discussion on accounting standards 22 and 29 for non-corporate bodies at the Vijayawada branch held in the year 2021. He has a wide range of professional experience, which includes audit of large corporates relating to JK Group, Porter Group, subsidiaries of international clients, EFF, Virgin, exposure to GST audits of large corporates like JK Industries, etc. Sir has handled the bank branch audits of leading banks, which includes Union Bank, Indian Overseas Bank, ICAI Bank, etc. Sir has also handled the income tax assessments of corporates up to the tribunal level. With this brief, I take pleasure in presenting before you CAG Subramania Sarma sir, who will take us through the special aspects in reporting, SA 700, 701, 705, 706, and also CARO compliance. Over to you, Sarma sir.
Okay, thank you very much. Good evening to one and all. It's a great pleasure to be before the members that, and also on aspects relating to auditing standards, which has become of more importance. As professional chartered accountants, we have to comply right from the beginning of accepting the audit till the completion and giving the report, and also documenting the files, the complete set of auditing standards. Further, this is an opportunity. I take this as an opportunity to read once again the standards which are required to be discussed, so that the new aspects can be thought of, and the new, based on the discussions the members raise, it is beneficial to all of us. The standards that have been taken up for discussion today, the close one.
Sir, visible, sir. Screen share.
Oh,
can continue.
Is SA 700, SA 701, 705, 706, and also the compliance and CARO, Companies Auditors and Report Order 2020, which is applicable for the financial years ending 31st March 2022 and subsequent years. At the beginning, I just wanted to caution some aspects we have to keep it in mind before we take up the aspects, before we take up the discussion on auditing standards. See, primarily all the auditing standards are based on the premise that before the audit is commenced, the draft financials is available to the auditors, which is approved by the management. Based on the draft financials which is available to us, we are required to take up the standards one by one and determine the materiality, performance materiality, assessment of risk, assessment of significant risk, controls. All those things we may have to take it up based on the information available in the draft auditors, draft financial statements. Once we get the draft financial statements, we can look to the areas of importance based on the various aspects given in certain auditing standards and proceed to verify the selective areas or selective items or samples being determined by us for verification purposes. This is the theory aspect. The practical aspect in most of the SMEs or small and medium companies, if we look into it, we follow the bottom-top approach, which means we send our staff for verification of vouchers, verification of documents, records, etc. Note down the various discrepancies, try to complete or pass and rectify the entries, prepare the trial balance, schedules, financial statements, and then give the audit reports. While the standards are all based for applying the top-down approach, in practice, most of the SME auditors or for most of the small and medium enterprises, the audit is not done on the basis of the top-down approach. So this aspect we have to keep it in mind while understanding or while reading and understanding any of the auditing standards. Of course, this particular thing may not be applicable for the standards which we are discussing now, because when we issue the audit report or when you form an opinion on the financial statements and then give the report, the financial statements are ready. The financial statements and the books and documents are all verified, analyzed, misstatements are noted down. Either most of the misstatements noted are corrected, etc. will happen. So the word of caution is only to make a proper understanding of the auditing standards in general. Now, how I'd like to take up this particular discussion is we'll take up SA 700, 705, 706, and then go to CARO, and key audit matters we'll keep it at the end. The reason being is for most of the practitioners, the key audit matters is not a standard which is to be generally applied unless the audit is for the listed companies. So we'll take the key audit matters discussion at the end. Now, SA 700 is the standard which is given for forming an opinion on the financial statements and issue of audit report. SA 700 promotes consistency in audit report. Consistency in audit reports, when the audit is conducted in accordance with the SCAs, promotes reliability in the global marketplace by making more reliable, identifiable standards. That the audits have been conducted in accordance with globally recognized standards. So SCA 700, while we issue the audit, will enable to issue the audit report, which will help the intending users to appreciate the audit work done by the auditors. In SA 700, the objective is to form an audit opinion on financial statements based on the evaluation of conclusions drawn from the audit evidence obtained, plus express clearly through audit report that describes the basis of opinion. See, both these aspects are important in SA 700. So without forming an opinion on the financial statements, the auditor cannot give the audit report. Without giving the audit report, forming an opinion on financial statements is as good as not doing any work. So the standard is divided into two parts. First is how to form an opinion in financial statements. based on conclusions drawn from the audit evidence which is obtained. And second aspect is how the audit report is to be drafted and what are the contents of the audit report is clearly explained in the standard. Now, before we proceed for the discussion on the SAS 700, it would be better if we understand certain aspects or certain definitions or certain abbreviations which has been given in the PPT, which is already shared to the SIRC, and SIRC will share to the members who are attending the meeting. FS is financial statements. Financial statements means set of GPFS, that is general purpose financial statements, including the related notes. The notes consist of summary of significant accounting policies and explanatory information. General purpose financial statements includes, among other things, the balance sheet or statement of affairs, the statement of profit and loss, cash flow statement wherever it is applicable, because there are certain exceptions given to the small companies regarding the applicability of the cash flow statement. Then explanatory statements, explanatory notes which forms part of the financial statements. See, this GPFS, the general purpose financial statements, is basically prepared with the purpose that the same will be used by the various stakeholders, be it whether it is a government or banks or lenders or even the general public. A financial statement, if it is restricted for usage for any of the stakeholders, or it is intended to be given or intended to prepared and given exclusively to a particular person, then it can be treated as not a general purpose financial statement. But any statement, once the auditor has put his signature, the intending client can give it to any of the persons, unless on the face of the statement, this statement has been prepared exclusively for the specific purpose and cannot be used for any other purpose. So any statement should comprise and qualify to be as general purpose financial statements only. Now, general purpose reporting framework. See, financial reporting framework is basically the requirements that the financial statements has to comply with. The financial reporting framework could be governed by the statutes under which the financial statements are prepared. If not, the financial reporting framework prescribed by the government or government agencies or autonomous bodies like the Institute of Chartered Accountants of India, and also certain financial reporting standards like accounting standards, etc. So if any financial statement which is not complying with the accounting standards, because accounting standards deal various items in the financial statements, various items and aspects of financial statement which discloses how to recognize, how to measure, and what are all the disclosures to be made in the financial statements. Such financial statements cannot be treated as a financial statements prepared under the reporting framework. Now, the financial reporting framework, the general purpose reporting framework, is basically designed to meet the common financial information of a wide range of users. The general purpose financial framework can be classified into fair presentation framework or a compliance framework. The difference between the fair presentation framework and the compliance framework is the following. So the compliance framework, in addition to the complying with the compliance framework, if there is a necessity for the management or an assurance from the management that they will disclose items which are required to provide additional disclosures, or on the other hand, to depart from specifying the minimum disclosure requirement if it can achieve the fair presentation. See, if these two options is available in complying the general financial reporting framework, then it will be treated as a fair presentation framework. If the option is not there, then it is a compliance framework. So compliance framework means compliance requirements without any deviation. So if there is a deviation such that the additional disclosures are intended or additional disclosures is agreed to be given, or certain disclosures, though excluded, to be given to achieve fair presentation, then it is a fair presentation framework. The next aspect which is discussed in this particular thing is a misstatement. Now let us understand what is a misstatement. The financial statements contains assertions which are statements saying that the items included in the financial statements complies with certain aspects like the amounts present, how it is being presented, what are all the things it is disclosure requirements. So all these assertions are is being checked at the time of audit. Now the misstatement could be the difference between the amount, classification, presentation, or disclosure of an item in the financial statement and the same aspects as applicable to the financial reporting framework. So if the items in the financial statements comply with the requirements in the reporting framework, then there would not be any misstatement. But if there is a deviation, such deviations are to be treated or classified as misstatement. Certain misstatements could be not material individually, but put together the aggregated the financial aggregated material misstatements could be material, which may affect the forming an opinion for issuing an unqualified opinion. So we can understand this particular thing with the example. What could be the misstatements? So let us take the inventories. Accounting Standard 2 requires inventory to be disclosed as raw materials, finished goods, trading materials, stores and spare parts, like that. The same can be either disclosed on the face of the balance sheet or given as a notes in the notes to the financial statement. Suppose the financial statements describes inventories as a single amount without classifying the following, without classifying as required in the financial statements, then there is a misstatement. Second aspect could be like this particular thing. This inventories are to be valued at cost and net realizable value, which are cost are least of cost and cost or net realizable value. Suppose the financial statements, in the financial statements, the inventories are valued only at cost, with a specific disclosure that it is valued only at cost, then there is a misstatement. So the misstatements can be related to individual financial statement areas, or some of the misstatements can be pervasive to the entire financial statement areas. The example could be then, suppose the control mechanism is not there, approval of documents, approval of payments is not there, that there's a deficiency is there. Such type of things does not gets limited to any one financial statement area, but it goes pervasive to all the aspects of the financial statements. So the financial statement, the misstatements could be related to a particular financial statement area. Hello.
In extra decision, strengthening capital gain, like assuming that holding
Yes, sir.
Hello. Hello.
Continue, sir, please. Then, no, the audience might have earning lead seems so. You can continue, sir, please.
Can I proceed then?
Sir, please continue, sir. Please continue, sir.
Okay. Okay. The misstatements can be limited to the individual financial statement area, or it can be pervasive to the entire financial statement area, because this aspect is to be taken up at the later point. Now, the financials, the SC 700 consists of two parts. One is forming an opinion in the financial statements, and the other aspect is expression of an audit report, giving an audit report in writing. Now, how to form an opinion in the financial statements? Now, this consists to three subparts. Now, first aspect is the auditor shall evaluate whether the financial statements are prepared in all material aspects in accordance with the applicable reporting framework. So this is one aspect the auditor has to take into account. Whether statements are prepared in compliance or in accordance with the applicable reporting framework. Suppose if the disclosures and other aspects as required in the reporting framework is complied with, generally the auditor can come to the conclusion that the statement is in accordance with the reporting framework. Now, how he can do this particular thing? One is he can review the entity's accounting practices. See, this accounting practices is one aspect which you have to keep it in mind, because while documenting various transactions, certain practices are being followed by the management. One of the standards requires that if the people manning the finance department or people in charge of preparing the financial statements are writing the documents and other things are not qualified, there is every chance the mistakes can be coming into the aspects of financial reporting. So accordingly, the financial there could be a misstatement that can arise. The next aspect is possible bias in management judgments. So this aspect is one thing, is because various judgments relating to provision for doubtful debts, then accounting estimates, provision of warranties and other things requires a lot of judgments to be made by the management. So there could be a bias. The bias could be like this particular thing. The attitude of the management is only to accept and correct matters which increase the revenue or earnings. But there is a misstatement or there is an aspect where the earnings are to be reduced or provision of expenses is to be made. They may show a reluctance in taking that particular scenario. Then there could be possible bias in making accounting estimates. So the accounting estimates being like provision for contingent liabilities, guarantees, warranties, etc. So there could be a bias in making the accounting estimates. All these aspects, when the auditor reviews it and prepares to take up the audit, keeping all those things, then the financial statements prepared in those aspects could be satisfy the applicable financial reporting framework. The next aspect is auditor should conclude whether financial statements as a whole are free from material misstatements, whether due to fraud or error. Whether he has got reasonable assurance on financial statements, alternatively, I'll put it. Whether the auditor should conclude whether reasonable assurance has been obtained, whether financial statement as a whole are free from material misstatements, whether due to error or fraud. He can make up this particular thing by performing or by obtaining sufficient audit evidence, regardless whether it corroborate or contradict the required assertions in the financial statements. So when the audited transactions being taken up, every statement of area, every financial statement area, when you take up the audit or when you verify the transactions, etc., the primary purpose is to test the assertions, be it completeness or be it valuation and be it a disclosure. So these aspects of the assertions. So audit is generally performed to validate the assertions. Now, para 27 of the SA 330 specifically requires the auditor after the end of the audit should document precisely that he has obtained evidence to satisfy the requirements of assertions. The next aspect could be uncorrected misstatements are material either individually or in aggregate. So para 11 of SA 450 requires to list down the uncorrected misstatements. Now the summary of this could be either individually material or in aggregate it could be material. So when these type of aspects is come, the auditor cannot be able to find out, obtain a reasonable assurance. Now, the review of the requirements of ARFW. Now, he can look into this particular thing by whether the financial statements, say as I was telling, the compliance reporting, the financial statement comply with the basic reporting requirements. There are certain aspects which are to be complied with. And these are some of the aspects. Whether the financial statements disclose adequately significant accounting policies, whether the accounting policies selected or applied are consistent with the reporting framework, whether the accounting estimates management by the made by the management are reasonable, whether the presented information is relevant, reliable, comparable, and understandable, whether the financial statements adequately provide disclosures to enable intended users to understand the effect of material transactions, whether the terminology used in the financial statements are appropriate, and whether financial statements, whether there is a fair presentation is ensured. Now, these aspects, when they satisfy, now, or when the auditor reviews and comes to the conclusion of these things, he can come to the conclusion that the financial statements meet the appropriate reporting framework. Now, the auditor has done both the aspects. Now he has to come to the conclusion. What type of conclusions he can come? He can conclude the financial statements prepared comply with the requirements of applicable reporting framework and achieve fair presentation. That is one aspect he can come to the conclusion. Next conclusion, alternative conclusion is financial statement prepared does not comply the requirements of reporting framework or is unable to obtain sufficient appropriate audit evidence. In the first aspect, if he comes to the conclusion that the requirements of applicable reporting framework is there and the financial statements achieve fair presentation, he can give unqualified opinion. If the financial statements prepared do not comply with the requirements or is unable to obtain sufficient appropriate audit evidence, which could be for various reasons. And one of the reasons could be the limitations in the scope of audit made by the management. In these cases, he has to give the modified opinion as per SA 705. The next aspect could be the financial statements comply with the applicable reporting framework, but do not achieve fair presentation. In such a case, what the auditor should do is he should discuss with them, he should note down the thing and discuss with the management. And based on the discussions and the replies and responses he got it from the management, he has to decide whether to issue a modified opinion. So based on the discussion, if he is satisfied, then he can consider issue unqualified opinion, but in 9 of 10 cases, he has to take the decision to issue the modified opinion only. The next aspect is, the first aspect is he has to form a conclusion. The second aspect is he has to express the report in writing. Auditor's report has to be in writing. Auditor's report is required to contain certain standard formats which has been prescribed by in this standard. The following are some of the aspects. It should contain a title saying that as independent auditor's opinion, independent auditor's report. Then it should be addressed to a specific person. In the case of the companies, it could be addressed to the members. Then it should contain an introductory paragraph. Generally, in introductory paragraph, the paragraph will define whose company's auditor's report is, whose the audit report contains on what these financial statements of such and such company for such and such period. The financial statements comprising various aspects. As we said, the general purpose financial statements consists of balance sheet, statement of profit and loss account, statement of changes in equity, where Ind AS is required to be followed, then cash flow statement, significant accounting policies, notes, etc., etc. It is those aspects which the audit report covers. And what is done by the auditor has to be mentioned. Say, in this particular paragraph, the auditor should specifically say he has audited the accounts. Subsequently, the audit report should contain the responsibility of the management. And it should also disclose the responsibility of the auditors. See, auditor's responsibility is a must in the audit report because it tells to the entire public what is the purpose of audit and what is consists of audit and what type of assurance the audit supposed to give and what can be expected by the public. So some of the aspects is the auditor's responsibility to say that the audit has been done in accordance with the statements of audit standards on auditing. Then it also contains the period and identify those which are covered in the audit opinion. The purpose, the auditor's responsibility should specifically tell that the purpose is to achieve a reasonable assurance. And after discussing the various aspects, he makes an assertion to the public that he has obtained audit evidence which is sufficient and appropriate to form a basis of opinion. Then subsequently, the audit report will contain opinion. The opinion should always be in a paragraph with the heading opinion. As we have seen, opinion could be an unqualified opinion or a qualified opinion or a disclaimer or adverse opinion. In all these cases, it should contain the separate heading. And in case the opinion is a modified or adverse or disclaimer, there should be a specific paragraph with the heading and basis for coming to the conclusion of such modified opinion, which should disclose, among other things, why a particular qualification is being made and what type of misstatements are there, whether in what are all the areas the financial statements get affected, what is the impact of such thing in the statement of in the reported earnings and also items in the balance sheet. Then the signature. The signature should have a proper authority, whether he is signing as a proprietor or on as a partner, either on behalf of firm or LLP, and also mention the membership number, firm registration number, UDIN, etc., etc. Then date of audit report and place of signature. Even if the prescribed audit report. Now, one aspect is comes. Now, the standard has prescribed a certain format of reporting, but there are certain requirements where the auditor has to give the report in the format given by the respective legislation. Let us take the case of Form 3CB and Form 3CD for tax audit purposes, where the reporting has been given by the prescribed authorities, namely under the Income Tax Act. Now, those items of reporting does not contain the management's responsibility, auditor's responsibility, etc., etc. It doesn't give that particular scenario. Even in those cases also, the auditor has to prepare a report in the prescribed format as given in SA 700, and he can attach it as part of the financial statements there, even though in the format he has to sign the respective audit report. So this aspect has to be kept in mind by the members. This is the three aspects what all we have done. In practice, in most of the cases, what we do is we take the last year's financial audit report. Could be either for the current, the same auditor, same entity, or some other entity, and then start doing this particular cut paste or cut copy paste aspects. There are certain problems in doing this earlier reports, audit report. These are all the things which we have to keep it in mind and ensure that these mistakes are not made. One, check whether the entity name is the same. It's possible that we have copied some other entity's audit report and not changed the name. Check whether the period for which the report is given is changed. See, last year's balance sheet asset, the audit report on the balance sheet asset that was March 2021 itself will be there. We intend, without any intention, we would not have changed that particular, but we have to keep that particular thing in mind. Whether the results for the year is properly stated. Say in the audit report, we say that profit for the year or loss for the year. Whereas actually in the profit loss account, it could be a profit. Whereas because we copied from the last year somebody's report, which contains loss per year, we would have given that particular. This aspect we have to keep it in mind. Check whether the opinion and basis of opinion is altered to suit this year's requirement. Even the last year's audit report would have taken for the same entity, which might have contained the qualified opinion. But in the current year, we do not intend to issue a qualified opinion, but unless we take pain to change that particular paragraph, there's every chance that the audit report given could be totally wrong. Similarly, the various requirements of CARO, some aspects may not be applicable because in the earlier year there might not be inventory. So we would have said inventory requirement, reporting an inventory requirement is not applicable. Suppose in this current year inventories are there. Now we should take pains to include those aspects also. So copy paste will have certain issues which we have to keep the precautions. The next aspect is it 700? Okay. See, this is the aspect with regard to the SA 700. Now, let us move to SA 705. Modification to the auditor's opinion. See, this comes when the auditor is required to modify the opinion. there are certain circumstances in which the auditor cannot give or cannot issue an unqualified opinion. When the auditor concludes that financial statements as a whole are not free from material misstatements based on the audit evidence which he has obtained, or is unable to obtain sufficient appropriate audit evidence to make such conclusions, then modification to the auditor's opinion is necessary. For unqualified opinion, in SA 700, these two things is there. One is auditor concludes that financial statement as a whole are free from material misstatement, and he is able to obtain sufficient audit appropriate evidence to make such conclusion. These two conditions, if dissatisfied, unqualified opinion is to be given. Where any one of this aspect he could not get, then he has to necessarily issue a modified opinion only. Now, what is modified opinion? Modified opinion is the one which is not a qualified, which is not an unqualified opinion, or which is not a clean report. When he is supposed to issue the qualified opinion, based on audit evidence obtained, if the auditor concludes that the financial statements as a whole are not free from material misstatement, or auditor is unable to obtain sufficient appropriate audit evidence to conclude that financial statement is free from material statement, there could be a reason because on the limitation on the scope of audit. In those two situations, modification is required. The modification to auditor's opinion could be in three formats. One is qualified opinion, then second is adverse opinion, the third is disclaimer of opinion. See, when the qualified opinion is to be given, let us look into it. Having obtained sufficient appropriate audit evidence, the auditor concludes that the misstatements either individually or in aggregate are material, but it is not pervasive to the financial statements. So there are misstatements in the financial statements. It is affecting in some of the areas, but it does not entirely travel to the complete aspects of financial statements. Then the auditor has to take a view. The second aspect, suppose if he is not able to obtain the sufficient audit appropriate evidence itself to base an opinion, the possible and concludes that the possible effects of undetected material misstatements could be material but not pervasive. So which means once he obtains appropriate audit evidence and concludes there are misstatements, second thing is he is not able to obtain the sufficient appropriate audit evidence, but concludes that there are possible effects of undetected material misstatements which are material, but it does not get pervasive. In these two situations, the auditor can give a qualified opinion. The other opinion is an adverse opinion. Suppose based on audit evidence obtained, if the auditor concludes that the misstatements are either individually and aggregate or both material and pervasive. See, in the case of unqualified opinion, there are material misstatement, but it is not pervasive to the entire financial statement area as a whole. But if it is pervasive to the entire financial statement area as a whole, then he has to issue an adverse opinion. Suppose if he is not able to obtain the audit evidence to base his conclusion, and the possible effects of undetected misstatements, if it is both material and pervasive, then he has to issue disclaimer of opinion. Now, this chart clearly explains financial statements are materially misstated. Auditor is unable to obtain the sufficient appropriate audit evidence. With these two situations, suppose if the conclusion is the possible effects on financial statements are material but not pervasive. If the financial statements are materially misstated, then you can issue qualified opinion. But if it travels, it is material and pervasive. In first case, it is an adverse opinion. Whereas in the second issue, in the case of inability to obtain sufficient appropriate audit evidence, if the misstatements are material but not pervasive, he has to issue qualified opinion. But if the misstatements are material and pervasive, then he has to go for a disclaimer of opinion. So this aspect we have to keep it in mind, which is being dealt in SC 705. Now, what could be the limitations imposed on the scope of audit? Say the limitations could be imposed on the scope of audit could be beyond the control of the entity, or it could be due to the nature and timing of auditors' performance of auditors' work. See, in a case where it is beyond the control of the entity, the possibility that the entire entity's records are destroyed in a fire, or the authorities under the Constitution might have seized a major portion of the records. Say, in the case of search and seizure, the income tax departments take away the records of the company. In such situation, there could be a limitations on the scope of audit. On the other hand, there could be in the performance of audit report, audit itself, there could be a limitation because the appointment could have been made much after the year end, due to which the physical auditor cannot be present during the physical count of inventories. He may not be able to do the valuation. So it is quite possible in the case of equity method of valuation followed for investments, the entity's balance sheet, that is in the balance sheet of the entity in which this company is holding investments, may not be available to the auditor to look into it. So these are all the things which may be due to nature and timing of auditor's work. The next aspect is the auditor is prevented from performing certain work, or auditor is not allowed to obtain confirmations directly, or he is not allowed to get being present while doing the physical verification. In all those cases, there are the limitations imposed on the management. Now, if there are limitations imposed on the scope of audit, then the auditor has to take a call whether such aspect has to be brought into the auditor's report, either which may result into a modified opinion, or it could be a para under matters under other paragraph, which is coming in SC 706. Now, let us understand what the auditor has to do. Suppose once he decides that he is aware of the limitation. Now, the auditor has to discuss with the management to remove the limitation. Once he discusses with the management, the possibility could be two views. One, the management refuses to remove limitation, or management removes the limitation. The management removes the limitation, he can perform the audit and then do it. Suppose if the management refuses to remove the limitations, he should communicate the matter with those charged in governance and try to perform other alternative procedures to obtain sufficient appropriate audit evidence. Now, he discussed with communicated the matter with the management and persons those in charge of governance, and he is trying to perform the other alternative procedures. In that situation, two possibilities there. He could have got sufficient appropriate audit evidence, and he need not have got sufficient audit appropriate evidence. Now, in that situation, he should qualify the opinion if the possible effects of undetected misstatements are material but not pervasive. Then he also should take a call whether he should resign from the audit or resign from the engagement, if it is possible and practicable, and if it is not prohibited by law. Now, recently, the SEBI has given certain circulars where the auditors cannot resign in between. While they perform the limited review, he has to complete the limited review for that particular quarter and then only resign. And if it is after the third quarter, then he has to perform for the fourth quarter and then resign. Certain limitations have been prescribed by SEBI with regard to resignations. So in those situations, he has to take a call. He feels the qualification opinion is not adequate to communicate the gravity of the situation. Now, before resigning, taking a call to resign, he should communicate again with those charged with the governance on any matters regarding misstatements identified that would have given to raise a modification. He has decided to issue the qualified opinion where he could not resign. But when he could not resign, then he should communicate with those charged of management, explaining what are the misstatements identified during the course of audit and which has given rise to modification. And he should give disclaimer of opinion if the resignation is not possible and practicable. If it is possible, he can resign. Before resigning, he should communicate and tell what is the reason for taking a call to resignation. If it is not possible to resign, then he has to give the disclaimer of opinion. See, certain cases where he cannot resign is in the case of audit of C&AG, the auditor cannot resign. If he resigns it, subsequently he will not get the C&AG audit at all. Such type of things, in those cases, he should take a call to issue a disclaimer opinion. Now, the auditor has decided to issue qualified opinion or disclaimer of opinion or adverse opinion. How he should include it in audit report? Auditor should include a para for the basis of modified opinion, wherein the description and effect of the qualification on individual item in the financial statement and cumulative effect is to be disclosed. Suppose the inventories are not valued at lower of cost or market value, the lower of cost or net realizable value, but it is valued only at cost. Then the auditor has to explain this particular thing in the paragraph or basis for modified opinion and explain saying what is the impact. Suppose had the same has been done at lower of net cost and net realizable value, what is the value and how the profit or the inventories in the balance sheet, reserves and surplus will change. He should describe the same in the audit report and should not just refer the notes. See, it's quite possible in some of the cases the management required to just refer the notes and don't give the complete description in the audit report. The standard requires that the basis for opinion, modified opinion, should contain complete description. He cannot just refer to the notes. The next aspect we regard to SA 706. This is emphasis of matter paragraph and other matters paragraph in the auditor's report. Now, what is emphasis matter paragraph? What is other matters paragraph? In the case of emphasis matter paragraph, the respective subject matter is already proposed, already presented and disclosed in the financial statements. But in the auditor's judgment, it is fundamental to the user's understanding of the financial statement. If he comes to that conclusion, then he should bring that matter into the emphasis matter paragraph. Now, what can come under the other matters paragraph? Those matters which are not presented or disclosed in the financial statement, which does not form part of the financial statements, but the auditor feels it is relevant to the user's understanding of the auditor's responsibility and auditor's report. So if any particular matter which the auditor feels that it will enhance the understanding by the intended users about the audit or the responsibility of the auditors or the audit report, then such aspects will come under the other matters paragraph. The emphasis of matters paragraph examples could be, see, sometime in the mid-90s and first decade of 20th century, the excise valuation for cigarettes was a big matter which was running more than about 7 to 8 years. The ITC being a major manufacturer of cigarettes, they had a big problem, and the excise valuation aspect was a big thing which the auditors, though disclosed in the notes to accounts, the auditors thought to bring it into the auditors' reports. That is an emphasis matters paragraph. Second aspect is certain accounting standards, though applicable from a prescribed date, it is allowed to be adopted in the even to the prior to that particular date. Suppose if the management has decided to adopt such accounting standards, though it is not mandatory before the respective date, it will have an impact on the entire financial statement areas. So in those type of situation also, the auditor should explain in the emphasis matter paragraph that the accounting standard has been adopted by the management, even though it is not mandatory, and what is the impact of that particular thing. The major catastrophe that has a significant on the auditors, the entity's financial position. 2 years back, the COVID, the impact of COVID is such, almost it has a significant impact on every financial statements. So every audit report contains a paragraph on the particular aspect of COVID and how the management has dealt with that particular thing, how the management feels that the impact of COVID can be controlled, or what could be the thing. So these are all certain aspects which is relating to emphasis matter paragraphs. Now the issue will come to the other matter paragraphs when necessary. As we've seen earlier, other matter paragraph is those which is not disclosed in the financial statement, but the auditor decides that it is important to make out this particular thing. Now, while doing the modified opinion, we have seen that if the auditor is unable to resign from the engagement due to the limitations in the scope of audit imposed, he can consider by including the same in the other paragraph why it is not possible for him to resign from the engagement. If it is possible to resign, he should resign from the engagement. If it is not possible to resign, then he should, even though he can qualify the report, modify the opinion, but he should include a paragraph why it is not possible for him to resign. The other matter paragraph examples is consolidation auditor generally include a paragraph stating that certain subsidiaries is not audited by them, or it is done by other auditors, and they have relied on the reports. In most of the bank audits, the central auditors will include as a paragraph saying that they have relied on the number of audits of branches done by the other auditors, and also unaudited branch returns which is of some of the branches they have considered and then by issuing the audit report. So this is the matter with regard to the other paragraph. Now, where to include the emphasis matter and audit other matters paragraph. So in the case of emphasis matter, the audit should include immediately after the opinion paragraph. Okay. See, auditor should include immediately after the opinion paragraph in the auditor's report. He should describe that paragraph as emphasis of matter, and he should state in the emphasis matter paragraph, he should specifically state that the auditor's opinion is not modified in respect of the matter emphasized. So this is the requirements with regard to the emphasis matter. The other matters paragraph, the paragraph dealing with other matters, if it is forming part of other matters reporting, legal reporting, he can include in that particular thing, or if it is not thing, he can include it in anywhere in the auditor's report, but specifically mentioning that as a other matter paragraph. Now, till now we have discussed about 700, 705, 706 and 701 will keep it for some time, because CARO is one particular aspect which is important and may take certain extra time for us to discuss. Now, the issues in CARO is roughly around 28 items are to be reported under the new CARO. New reporting requirements have been given under the new CARO. Some of the matters which was there earlier in 2013 CARO, which was removed in 2016 CARO order, but has been brought back again in 2020 order. Additional responsibilities have been given on the auditors while reporting on the CARO aspect. The major possible issues which the auditors may face is, first thing is whether the auditor has to report all the points in para 3 and para 4 of the order is to be reported or not. Whether it should issue in each and every point and say this matter is applicable, this matter is, if it is not applicable, it should have to say that this matter is not applicable. Or can you ignore to report these specific things? The CARO specifically contains the auditor has to include all the matters in specified in para 3 and para 4 to the extent it is applicable. So if the matter is not applicable to the entity, then he need not report on that particular thing. But it is advisable for the auditor to report that particular matter also. The reason being is he has already taken a call and documented why it is not being reported. It is better. So how to make such reporting on matters which is not applicable is a question. It could be done in two ways. Take each and every matter and then say if it is applicable, give the reported requirements. If it is not applicable, let us say that particular paragraph is not applicable. Say suppose if the company does not have any inventories. We can say that the company does not have any inventories and hence the reporting requirements specified in para so and so dealing with inventories is not applicable and not reported. That way you can go ahead. Say while you're doing this particular process, is ensuring that audit report is complete and he has not omitted any item. The other alternative is report all the items which is applicable, and as a last clause, he can say that the following points, the following matters specified in clauses so and so, so and so. List out all the matters, list out all the class numbers, and say it is not applicable in his opinion, and hence it is not reported. So in both the cases, what will happen is quite possible some issues are applicable, but he has not reported that matter will not come. So for doing this particular thing, at least he would have applied his mind. Say he would not have skipped his attention. Now, what are the specific additional matters that has come up into this particular thing is the new CARO requires proper records are required to be maintained for intangible assets also. See, in the earlier CARO, intangible assets, it is not forming part of PPE, so hence that does not forming part of this particular reporting. Now, intangibles also forming part of PPE, so the auditor has to report whether the company maintains proper records for intangible assets also. The next aspect with regard to the titles of immovable properties held in the name of the promoters. Now, in the present CARO, the title deeds in respect of immovable properties, we have to say whether it is held in the name of the promoters or directors or their relatives or employees. That is first the statement of fact. They also should tell from which period they were held in the respective members, and also the reason why it is not being held in the name of the entity. So in the earlier CARO, the institute has, the guidance note has given the format of reporting. Now the order itself now specifically requires us to report this particular. So this has required necessarily the auditors to discuss with the management, find out the reason, check the title deeds, either if it is physically available or if it is lodged with the institutions for taking loans, then he has to take the confirmation to the effect that it is in the name of the company. So in some cases, only Xerox copies could be available. In those cases, he should ensure that only Xerox copies are available. Based on Xerox copies of the documents, he is coming to the conclusion that it is held either in the name of the company or not held in the name of the company. So this additional requirement of this review of this title deeds is to be done almost on a year-on-year basis. So we cannot rely on the last year's thing and then take a call. It is possible that new immovable property would have achieved, and then it could be either in the name of the company or not held in the name of the company. So this will have an impact in the case of audit of estates, where most of the lands of the estate, either be it the tea estate or the coffee estate, would have been held in the name of the original holders. It could not have been transferred to the company's name. It is also possible in some of the cases where acquisition of companies due to either amalgamation or absorption or signing up. In those cases, the title deeds will be in the name of the earlier company. The main reason for the company not to change in the subsequent name is because they have to pay the stamp duty to the respective registrar for this particular scenario. The next aspect is revaluation. Whether revaluation has been done by the managed by the on any of the assets, including intangibles. If it is done, whether it is done by the registered valuer. If the revaluation is done, whether the change is more than 10% of the carrying value. If it is exceeds 10%, the auditor has to specifically mention this particular thing in the audit report, which necessarily requires the obtaining of the documentation with relating a particular aspect of revaluation to come to the conclusion for reporting purposes. The next aspect is proceedings under the Benami Transactions Prohibition Act, whether initiated or pending at the reporting date. This requires a discussion with the management, particularly at the senior level, to understand what are the implications and other things, and then take to this particular scenario. It's quite possible. Let us take a call on this particular thing. Suppose if any of the company is having assets abroad, which is not disclosed under the income tax return. Now, there's every chance under the Black Money Act, the department can attach those properties. Possibility. Though it is not in the Benami Transactions Act, the auditors has to be careful while dealing this particular thing. Reporting on the coverage and procedures of physical verification of net. This was there in 2013 CARO order, removed under 16 order, but again brought into the 2020 order. Then reporting on the regularity of repayment of principal and interest with banks and financial institutions. Reporting on the loans which are repayable on demand or without terms and conditions on specific disclosures to the percentage, etc., etc. So this particular thing, see in the loan portfolio of the company's balance sheet, now the CARO covers the entire aspect, whether loan to subsidiaries, loan to non-subsidiaries, loan not to related parties, etc., etc. It covers almost everything. It covers even advances which are in the nature of loans, though it is styled as advances, but the auditor has to take a call whether it is a pure and simple advance or whether it is a advances in the nature of loans. So that also he has to cover this particular thing. So the CARO reporting more or less covers the entire aspects of the loan portfolio in the financial statements. Then reporting on the payment of dues of GST and withholding taxes. So in the case of VAT is also applicable. Service tax excise duty, they have replaced it with GST. In the case of GST, we have to be very, very careful while reporting on this particular thing, because if the ITC availed, which are required to be reversed, has not been reversed during the year, there is every chance that there is a liability which has not been disclosed, which has not been paid, which is outstanding. So the auditor has to comply, has to make a detailed working for the ITCs which is required to be reversed and not reversed, arrive the GST aspect, whether item is more than this particular aspect, the 6 months period, and he has to make out the thing. Withholding taxes, TDS. Non-payment of advance tax also will harm under this particular aspect. So as the audit with the company has not paid the advance tax. So there is a liability for advance tax which is due for more than 6 months, and it has to be covered in the CARO. Because this aspect we have to keep it in mind, and it requires a detailed application of mind, detailed documentation, and detailed instructions to the audit staff when they go for audit. The next aspect, reporting on the transactions not recorded in the books but offered for taxation authorities. It's quite possible in the case of search and seizure cases, the company would have agreed for possible additions. Those cases which will not be recorded in the books of account, such income would not have been recorded in the books. But to buy peace or to settle the dispute, the company could have agreed to take for the additional income, offering the additional income and pay the taxes on that particular thing. Now the auditor has to verify the income tax assessments not only carried out during the audit period, namely in the case of March 22, 1st April to March 2022, but should review the matters till the date of audit report, namely either it could be the end of August or end of September. Even in subsequent period also, if the matter has been accepted, then he has to include it in the auditor's report. Whether the company has been declared as a willful defaulter, whether term loans are utilized for the purpose for which it is taken. This was there in 2013 order. But now, in addition to this particular same thing, now the company has the CARO covers if it is not utilized, where it is utilized, where it is kept, and how the same utilized, how it is diverted for any other purpose. Now, term loan taken by the company, we can check it whether it is used for that particular purpose or not. It is quite possible term loan which has been taken will go to the cash credit account. It could have been used for the normal working capital operation purposes. So this particular aspect also sufficient care to be exercised by the auditor while reporting the CARO requirement. It is quite possible the company would have taken loans for the purpose of utilizing the same in the investment of subsidiaries, etc. So in those cases, the purpose for which the loan has been taken from any entity, it is not from the bank or financial institution, could be any lender. In those cases, it is for investment in subsidiaries or associates, etc. Then he has to disclose this particular thing. Reporting on the details loans taken on the basis of pledge of securities held in subsidiaries. It's quite possible that the company would have pledged the shares held in investment in associates or subsidiaries and had taken loan. No doubt, when they given the security has been created, the charge has been created, then it would have come as part of notes. Even though the same thing is disclosed in the financial statements, the auditor has to bring out that particular thing in the CARO report order. Enlargement of reporting of fraud and company and by the company. See, 2016 order was reading like that. Whether the auditor has noticed any frauds by the company or fraud by the company or on the company by the employees or officers of the company. Silently in 2020 order, they have removed the word by the employees. So with the result, if the fraud is done by any person, not necessarily by the employees, then the auditor has to cover this particular aspect also for the purpose of reporting under the CARO order. This can be done only by preparing the fraud risk assessment checklist based as required under the assessment of fraud one auditing standard, and he has to well document this particular thing to report on this particular thing. Fraud by the company is one thing which has to be very, very careful. Fraud on the company is okay. Fraud by the company. What is fraud? That they have to make out this particular scenario. Then whistleblower complaints. Now, whistleblower requirement is there for most of the listed companies. In the case of non-listed companies, some of the specified class of companies are required to have the whistleblower mechanism. And if any complaints have come and how the company has dealt with that particular thing. See, invariably, you'll find that the company will not give these details to the auditors. Any complaints, whether whistleblower companies, the company will say that management will simply say that they have not received any complaints. There's nothing is there. But still, the auditor has to take a call and then document in his working papers whether he has discussed this, raised an issue, and had, based on discussions, he has come to the conclusion. Then internal audit. Whether the company is having an adequate internal audit system in relation to the size and nature of the business. Now, internal audit is a must for listed companies and specified public companies, non-listed public companies, and specified private companies, which is expressly given in the one of the regulations under the Companies Act. Wherever the internal audit has been appointed, whether the internal auditor has covered the report for the same period, he has to look into it. Quite possible internal audit will be done from October to September, whereas audit is done for April to March. In those cases, the auditor has to specifically, suitable note has to be made out because internal audit report is for a different period. They have covered the entire reports. Now we have to take not only the final report, for considering the final report, the auditor has to take the draft reports by the internal auditor and also the replies given by the management to the internal auditor also is a must, because otherwise the final report may not disclose the deficiencies noticed by the internal audit. Then reporting on the incurring of the cash losses. This is again another matter which has been brought back. In the case of resignation of auditors, whether the new auditor has considered the reasons. The recent events has necessarily made the MCA to come out with the regulations with regard to the resignation of auditors. If the auditors have resigned, then they have to file a specific form ADT4 to the Ministry of Corporate Affairs, wherein they have to explain what is the reasons for the resignation with a copy to the company. The new auditor who is being appointed in the place of the resigned auditor should at least decide and find out what is the reasons for those particular things. No longer now it is possible to resign the company audits as due to pressure of work, due to medical reasons, etc., because those things have the MCA is taking a serious view in those aspects, such type of resignations. Reporting on it, this is the biggest thing, whether the company, the auditor has to report whether the company has got an ability to meet the liabilities existing at the balance sheet date as and when they fall due, which is not more than 12 months. Liabilities, completeness of the liabilities will decide for the purpose of audit. All the liabilities which are there on 31st March 2022, now the auditors has to decide based on the cash flow projections, based on the financial ratios and the other matters, other aspects which the auditor considers. He should come to the conclusion that in his view, the company is able to meet those liabilities as and when fall due, which is not more than next to 12 months. See, this is a very serious aspect. It's a very, very qualitative aspect. No matter of a few signs or pure document, pure figure matters cannot come. It is a lot of judgmental factors has to be taken, for which lot of documentation and discussions and sufficient working papers has to be maintained by the auditors for this particular thing. Now, these are all some of the aspects of CARO reporting requirements. Having noted this particular thing, what the auditor can do, at least he doesn't have an option to ignore CARO reporting. The best part which he can do is prepare a checklist and verify whether all the clauses are applicable to the entity. So you can prepare a checklist and give it to the audit team saying that what are all the aspects of the CARO which is applicable. So let the audit team prepare the documentation saying that this particular aspect is saying there are no inventories, there are no loads taken, there is no internal audit requirement, something of that type. Let them make it out. So let them keep a separate, let them make out a documentation saying that these clauses are not applicable. The engagement partner can review those documentation and come to the conclusion whether those things are really not applicable. That means 50% of the job is done. Then what are all the matters is applicable, cover those aspects in the respective financial statement areas. So in the case of audit of PPE, he can consider those aspects, proper records maintenance, then title deeds for immobile properties. If the revaluation has been done, those matters he can cover. Audit plan can be generated and included in the respected financial statement areas itself, so that separately we do not do again for the purpose of reporting in CARO. That has to be done as part of audit planning. Obtain detailed workings for various items. The clauses are applicable to the entity for verification. So even though PPE audit has been done for PPE, still for CARO requirements, either proper references for CARO working papers, you should go to the main audit working papers in the respective financial statement area, or the separate copy of this thing can be taken and then kept in the file for CARO reporting. Then prepare a detailed working documentation for each class, indicating what is the work done and conclusions drawn. This is very, very important because some cases it does not come under the financial statement reporting itself. Take the case of the willful defaulter. It will not be there. And fraud checklist. Once you prepare the fraud checklist and assessing the risk for fraud and other aspects, then those documentation has to be done and each and every year and kept in audit working papers. As I said earlier, what are the clauses which is not required to be reported? Either give it separately for each and every class is not applicable, or give a separate class which saying that all the classes which is not reported, but specify the respective classes and say this is not applicable and not reported. Say the recent report given by the TCS, Tata Consultancy Services, specifically mentions each and every class, saying whether it is applicable or not applicable. If it is not applicable, say the company says the audit report specifically is not applicable, but it is better to follow that particular thing that will not miss any attention. Now, this is with regard to the matters relating to CARO aspect. Now, coming to the key audit matters. What is the purpose of the auditing standard on key audit matters? See, the purpose of the key audit matters is to enhance the communicative value of the auditor's report. It provides greater transparency about the audit that has been performed. Suppose any particular matter which you have taken as a key audit matter, and then include it in the audit report, you are focusing something which is a particular aspect, and you are devoted more time on understanding those particular things, assessing the risks, how you have done the audit on those particular things. So generally, when you include it a key audit matter, it enhances the communicative value of the auditor's report. Now, how does it make? It provides additional information to intended users of the financial statements to understand those matters which are significant. So, key audit matter is one thing which is really significant in the judgment of the auditors and is including it. Now, those particular matter, the intending users understand them, why the same has been very important, how it has been dealt with. They can also understand the thing. And it provides the intended users also a basis for further engaging a discussion with the company. So suppose on a particular matter, say in the case of say revaluation, so in the case of the company dealing with lot of manpower, consideration of labor laws, legislations and other things could be a key audit matter. Now in that particular thing, the intended user may be a labor department. Once they find out this particular thing is there in the key audit report, they can send, communicate and understand why the same has been made and how this is important. What they can do with this particular audit aspect also can be done. Now the next aspect is to whom this key audit matters is applicable. It applies to general purpose financial statements of listed companies as of today. And also certain companies which are following NDAs, that too not under mid-level categories. But by and large, it applies to NDAs, the listed companies, which means whether non-listed companies, auditors of non-listed companies, can they include something in the key audit matter? There is no prohibition. If the auditor of a non-listed company considers any matter as an important and he has to bring it into the auditor's report under the heading key audit matter, he can do it unless there is a prohibition for doing that in any other law. Now, is there any prohibition in the auditing standards itself on key audit matters? If you look at audit SA 705, suppose if the auditor decides to issue disclaimer opinion, in that situation, he cannot bring out any matter as a key audit matter and include it in the audit report. So section 7, SA 705 prohibits communication of key audit matters when he disclaims an opinion unless such reporting is required by law. Once they give a disclaimer opinion, he cannot include a key audit matter. Suppose such reporting is required by law. In those cases, he can make out the thing. To my knowledge, the example could be this particular. There are some matters which the Reserve Bank requests the auditors to include in the audit report of NBFCs. Suppose the auditor disclaims an opinion on any NBFC company, and if he considers certain matter is a key audit matter, he can include it this particular because this is not prohibited by law. Then let us understand what is a key audit matter. These are all the matters that in the auditor's opinion or auditor's professional judgment were most significant in the audit of financial statements of the current period. So if in any item of an audit, the auditor considers is most significant, then he can take that as a key audit matter. Now, can he take any matter himself as a key audit matter? The answer is no, because those are to be selected from the matters communicated with those charged with the governance. So if at all I wanted to treat any matter as a key audit matter, then I should first include it in the matters which are required to be discussed with the management, not management, with the directors or persons in charge of governance. Those cases only we can take it up the thing. Now, what are the things I should treat an item as what items can be determined as a key audit matter? The auditor should take into account the following. One, areas where higher risk of material misstatements is there. Suppose there is a material misstatements areas are there in a particular areas, he can consider that as a higher possible key audit matter aspect. Significant risks identified as per SCA 315. In those cases, in all these cases, the rest of the other standards, audit standards, require these matters to be communicated to the persons in charge of governance. Once you include it in the matters included for bringing to the notice of the persons in charge of governance, the auditor can treat those items also as part of key audit matters. Significant auditor's judgment relating to the areas in the financial statements that involve significant management judgment. So there are certain areas which the auditor feels it involves significant management judgment, because the going concern aspect itself, the auditor has to take a call and then discuss with the management. That could be a major issue for some of the cases, some of the companies, some of the situations. So that also he can bring it out as part of the key audit matter. The effect on the audit of the significant events or transactions that occurred during the period. Now, let us take the case of the COVID itself. Suppose in some of the companies, if it is a very, very significant, the factory itself could not be operated for a major portion of the year, or the major fire or major earthquake or major accident that has happened, because that could be significant to the operations of the company. That could be a matter which is even which has occurred, which will have an impact not only during the current but even in subsequent years. Then the auditor can consider that also as part of key audit matter. Now, having decided this key audit matter, how it should be reported? Now, in the auditor's report, key audit matter has to be disclosed in a separate paragraph with a separate heading as key audit matters. Under that particular paragraph, suppose if the auditor has decided to include more than one item, then for each and every item, he has to he should describe the key audit matter with a subheading. So he cannot simply put it as a paragraph 1, 2, 3, 4 and other thing, because this is a significant aspect which he wants to bring to the attention of the intended user. So he has to appropriately give a subheading and then discuss this particular thing. Now, can the auditor can bring some items as key audit matter? I have issued a modified opinion. Can I bring it as a key audit matter? Now, the standard says key audit matter is not substitute for expressing audit opinion. So, modified opinion. I don't want to issue a modified opinion, but include it as a key audit matter. Then it's not possible. So, the standard itself makes out a specific thing. This key audit matter is not substitute for expressing the modified opinion. Key audit matters, the items included in the key audit matters, wherever possible, if it is covered in the notes, you should disclose the references made in the financial statements or in the notes, if any. And he should also describe why the same was considered as one of the most significant in the audit and determined as such. Now, key audit matters, if I want to bring it into the key audit matters paragraph, then auditor not only describes that as a key audit matter, he should also tell to the people that why he considered it as a key audit matter. Why is it really significant in his professional opinion, and not only how he has dealt with that in his audit, because this is something which are projecting as a 3D matter in the audit report, so that the intending users may not look to the other aspect, but only project on this particular thing to understand much better. Now, how the same was also addressed in the audit, because he has taken up the thing, what steps he has taken, how he has dealt with that matter while assessing the key audit matter risks and other things. Is he satisfied with those particular aspects? These are all the matters which he has to disclose it as a key audit matter. This is the particular standard. Now that the time is around 6:30, I thank all the members who are watching this program. a sincere thanks for giving a patient hearing on a subject which is generally dry. And I also thank the SIRC for giving an opportunity for again reading these 4 standards for enhancing knowledge and applying the same in our office. Now it's the time for if there are any issues which the members feel, it is my privilege to give my views on that particular thing, at least satisfy on the reported issues. Thanks you, one and all. Okay.
Oh, can I ask a question, please?
Yeah, yes, sir, no problem.
Yes. So there was a thing, what you said is pervasive, the situations which are pervasive and which are non-pervasive. Can you
May I know
explain
your
that?
good name, sir?
Yeah.
May I know
Sorry.
your good name, sir?
Yeah, my name is Indranil.
Okay.
My name is Indranil. So
Okay.
I wanted to know the concept of what is pervasive and what is non-pervasive. How do you define that? Pervasive to
Okay.
financial statement.
Okay. Sir, misstatements. I already covered this in my presentation. See, certain misstatements are restricted to the particular financial statement area. Suppose if the assertion aspects of, say, completeness is not there with regard to the fixed assets alone, let us take. If the procedures are not followed, if the company does not have a conclusion with regard to the fixed assets area, there is a misstatement with regard to the financial statement area alone. Suppose the inventories are complete, completeness is ensured for the inventories. Then the misstatement is restricted to the one particular financial statement area. Okay. On the alternative, suppose we noticed that the company does not have a procedure to identify whether all the items in the factory belongs to the company or whether all the items in the books as fixed assets are physically available. It's quite possible it has been sent to some other place. So if they could not do this particular thing, this is the misstatement relating to the fixed assets area. Now, the same concept, having known myself this particular thing, the management does not have a control or a mechanism to check this particular thing. The possibility of this can go even to the inventories is there. So that is exactly the pervasive matter. So one item particular thing, it may relate to fixed assets, particular specific area, whereas the effect of that may not be related to that particular thing, but the aspect, the management not covering that particular procedure for assessing that particular risk completeness. Now it may travel to inventories also. That is one thing. Generally, the misstatements, pervasiveness of the financial state, the misstatements goes to control aspects. See, suppose take the case if the payments are not authorized properly. Now that control weakness or a misstatement which travels not only to the particular thing, it has a impact on almost all the areas, all the aspects of financial statement. That is the concept of pervasiveness. Hope I think I have clarified.
Yes, sir. Yeah, thank you.
Yeah, thank you.
Sir, tell me, sir.
Yeah, tell me, sir.
No, sir. Are we done with the presentation or yet to be completed, sir? Because
And I have completed the presentation. If members wants any clarification,
No, sir. Is there any query? Members can unmute themselves and they can ask the sir. So we are not yet done with presentation, right, sir?
Okay, then.
We can continue.
Anyway, let me thank the institute for giving me this opportunity. The knowledge, whatever I have shared may be minimum, but I have enriched by reading this particular standards at least more than twice. So I sincerely thank the members for giving the opportunity. Thank you.
Yes. Thank you so much for your excellent time spent here, sir. Among with the members, we'll share the presentation among the members along with the recording in a due course, sir. And on behalf of SIRC Chairman, Secretary, and Office Bearers in the absence, thank you so much for the time spent here, sir. Thank you.
Thank you very much, sir. Thank you. Bye.